Something changed on your payslip this year. You may have noticed it, you may not. But whether you spotted it or not, the change was real. And for some people watching this right now, there is a second change coming that affects something far more important than a monthly deduction. It affects the state pension you will eventually receive, and whether the years you spent working outside the United Kingdom will count toward it the way you always assumed they would. Welcome back to HMRC Update. Today, I want to walk through the national insurance changes that came into force in 2026. What changed for employees, what changed for employers, what changed for anyone who has ever worked or lived abroad, and what HMRC is doing right now in July 2026, specifically around those overseas contributions. Because if you are in any of those groups and you have not yet taken action, this video is the conversation you needed to have before the letter from HMRC arrived. If you are not subscribed to HMRC Update, please do that now and hit the bell. National insurance is one of those areas where the rules change quietly, the consequences arrive slowly, and the people most affected are usually the last to find out. Subscribe. Let us get into it. I want to start with the change that affected every employed worker in the country and that has been reshaping payrolls since April 2025, because its effects are still being felt in 2026 in ways that are creating genuine confusion. Employer national insurance contributions. The employer national insurance rate sits at 15% for 2026 to 27, following the increase introduced in the previous tax year from the previous rate of 13.8%. That 1.2 percentage point increase sounds modest in isolation. In practice, the annual cost of a single employee could increase by as much as £865.80 from 6 April 2026 for employers. Across a workforce of 10, 20, or 50 employees, that figure scales rapidly into a significant additional cost that
employers were given relatively little time to prepare for. The secondary threshold, the point at which employers start paying national insurance on an employee's wages, remains at £5,000 per year, down from £9,100 before April 2025. The combination of the higher rate and the lower threshold means employers are paying more national insurance on more of each employee's salary than at any point in recent years. That is an employer cost, not a direct employee deduction, but its indirect effects on employment decisions, salary review budgets, and the cost of taking on new staff are real and are being felt across businesses of every size. The employment allowance, the relief that allows eligible employers to reduce their annual national insurance bill, increased to £10,500 for 2026 to 2027. That relief is available to employers whose total employer national insurance bill in the previous tax year was below £100,000. For smaller businesses where the employer NI increase has hit hardest, the higher employment allowance partially offsets the additional cost, but it requires the employer to claim it through their payroll software. It is not applied automatically. If your business is eligible and has not claimed the employment allowance for 2026 to 2027, that is an immediate action to take. The relief reduces the amount of employer national insurance transferred to HMRC each month and is worth up to £10,500 over the year. Your payroll software or accountant can apply it to your current payroll if it is not already in place. For employees, the direct national insurance position has not changed as dramatically in 2026 as it did in the previous 2 years. Employee Class 1 contributions remain at 8% on earnings between the primary threshold and the upper earnings limit, and 2% on earnings above the upper earnings limit. The lower earnings limit for 2026 to 2027, the threshold below which no contributions are due and above which contribution credits are earned, is
$6,708 per year, or $559 per month. If your earnings sit between the lower earnings limit and the primary threshold, you pay no national insurance contributions, but you earn qualifying year credits toward your state pension. That is an important distinction that many lower-paid workers do not know about. The practical point for employees right now is this. The frozen personal thresholds due to the government's fiscal drag policy mean that even as gross pay rises to combat inflation, a larger proportion of that extra income falls into taxable bands, eroding the real value of those pay rises. Your employer may have given you a pay rise, your gross pay went up, but because the thresholds have not moved, a larger proportion of your gross pay is now within the national insurance and income tax bands than it was 2 years ago. Your net pay increase is smaller than your gross pay increase, not because anything was done incorrectly, but because frozen thresholds combined with rising wages pull more of your income into the taxable zone automatically. That is fiscal drag. It is deliberate policy, and understanding it is the difference between wondering why your payslip does not reflect your pay rise and knowing exactly what is happening. Drop a comment below if you received a pay rise this year and noticed your net pay did not go up by as much as you expected. You are not alone, and it is not a payroll error. Back to the most significant change of 2026 for a specific but substantial group of people. Now here is the change that matters most for anyone who has worked or lived outside the United Kingdom, and for their families. And this one has a deadline attached to it right now, in July 2026, that makes it genuinely urgent. From the 6th of April 2026, the option to pay voluntary Class 2 national insurance contributions for periods spent abroad has been permanently removed. From the 2026 to 2027 tax year onwards, only voluntary Class 3 contributions are available for those living or working outside the UK. To understand why this matters, you need to understand what voluntary contributions do. The full new state pension requires 35 qualifying years of national insurance contributions. If you have gaps in your record, years spent working abroad, years living overseas, those gaps reduce your state pension permanently. Voluntary contributions allow you to fill those gaps and protect your state pension entitlement. For decades, people working abroad have been able to pay either Class 2 or Class 3 contributions voluntarily to maintain their UK NI record. Class 2 was significantly cheaper. Class 2 contributions for time abroad cost £3.50 per week, while Class 3 contributions are set at a considerably higher weekly rate, currently £17.45 per week for 2026 to 2027. The abolition of Class 2 for overseas periods means the cost of maintaining a UK NI record from abroad has increased by approximately £725 per year for anyone who is using the cheaper rate. In July 2026, HMRC is notifying Class 2 contributors via post that they cannot continue with this class for the 2026 to 2027 tax year. The correspondence will also detail how to apply for Class 3 contributions under the new rules, and HMRC is highlighting the importance of ensuring postal addresses are up to date to receive this critical information. If you are currently living or working abroad and have been making voluntary Class 2 national insurance contributions, or if a family member is in that position, this letter is arriving now. Missing it does not change the underlying rule. Class 2 ended on the 5th of April 2026, regardless of whether you received or read the letter. If you want to continue maintaining your UK NI record for 2026 to 2027 onwards, you must apply to make Class 3 contributions instead. But here's the part that creates a genuine barrier for a new group of people, and this is where the eligibility change bites hardest. From the 2026 to 2027 tax year
onwards, to apply for new Class 3 contributions for periods abroad, an individual must meet one of two criteria. Either 10 consecutive years of UK residency immediately before the period abroad for which they wish to pay contributions, or at least 10 years of national insurance contributions before the period abroad. For people who have been living abroad for a long time and built up a UK NI record before leaving, meeting one of those criteria is likely straightforward. For people who left the UK earlier in their working life with fewer than 10 years of contributions, perhaps someone who emigrated in their mid-20s after 5 or 6 years of employment, the new eligibility rules may mean they no longer qualify to make voluntary contributions at all for their overseas years. That is a permanent loss of the ability to maintain their UK state pension record for those years. Those with limited previous connection to the UK who previously benefited from the lower Class 2 rates will likely experience the most significant impact. The critical point about timing is this. The changes do not affect the ability to purchase voluntary national insurance contributions for tax years prior to 2026 to 2027. If you have gaps in your NI record from years before April 2026, years spent abroad, years of low earnings, any period where contributions were not made, those gaps can still be filled under the old rules, including at the lower Class 2 rate where applicable. The window to fill historical gaps under the transitional arrangements that allowed people to go back as far as 2006 closed on the 5th of April 2025. But the standard 6-year backdating window remains open. Gaps from 2021 to 2022 onwards can still be addressed under current rules. If you have gaps in those years and you meet the eligibility criteria for Class 3 contributions now, acting before your personal circumstances change further is the correct approach. To check your national insurance record and see
exactly where your gaps are, log into your personal tax account at gov.uk. The record shows every qualifying year, every gap, and a state pension forecast based on your current record. If you are abroad and cannot access the personal tax account, contact HMRC's National Insurance Helpline on 0300 200 3500 and ask for a statement of your NI record and a state pension forecast to be sent to you in writing. Before paying any voluntary contributions, whether Class 3 for overseas years or Standard Class 3 for domestic gaps, always contact the Future Pension Center on 0800 731 0175 first to confirm that filling a specific gap will actually increase your state pension. In some cases, particularly for people who were contracted out of the additional state pension before 2016, filling a gap does not increase the final pension figure because of the way the starting amount is calculated. Spending money on a year that returns nothing is a mistake that is entirely avoidable with one phone call. There is one further change from April 2026 that applies specifically to employers, and that affects the cost of providing workplace benefits, and this one is worth knowing because it actually reduces cost rather than increasing it. From the 6th of April 2026, tax and national insurance exemptions were extended to cover employer-reimbursed eye tests, flu vaccinations, and home working equipment. Previously, certain reimbursements of these costs by employers were treated as taxable benefits in kind, meaning both the employer and employee faced a national insurance liability on the reimbursed amount. The exemption removes that liability entirely. An employer who pays for an employee's eye test, required for display screen equipment users, or who provides flu vaccinations as a workplace benefit, or who reimburses the cost of home working equipment for an eligible home worker, no longer needs to report those reimbursements as benefits in kind, or pay Class 1A national insurance on them.
This is a genuine reduction in employer costs that came into force in April 2026, and that many payroll teams have not yet fully reflected in their benefits in kind reporting. So here is where the complete national insurance picture sits in July 2026 and what you need to do with it. If you are an employer, the rate is 15% on earnings above the £5,000 secondary threshold. If you have not claimed the employment allowance for 2026 to 2027 and your total employer NI bill last year was below £100,000, claim it now through your payroll software. It is worth up to £10,500 this year. And if your business provides eye tests, flu vaccinations, or home working equipment to employees, ensure your payroll is not reporting those as taxable benefits in kind. The exemption applies from April 2026. If you are an employer wondering why your net pay has not risen in line with your gross pay, the answer is frozen thresholds and fiscal drag. It is not a payroll error. Your national insurance position has not changed dramatically this year, but inflation and wage growth combined with frozen thresholds means more of your pay falls within the NI and income tax bands each year. And if you are living or working abroad, or have ever done so, the Class 2 voluntary contribution option ended permanently on the 5th of April 2026. HMRC is writing to affected people now in July 2026 to explain the transition to Class 3. If you want to continue maintaining your UK NI record, you must apply for Class 3 contributions and confirm you meet either the 10-year residency or 10-year contributions eligibility criterion. Check your NI record at gov.uk or call 0300 200 3500. And before paying anything, call the Future Pension Center on 0800 731 0175 to confirm that the gaps you are considering filling will actually increase your state pension. HMRC did not arrange personal consultations to explain any of this. The rate went up, the threshold came down, the Class 2 option closed. The July letters are
going out now. The people who act on this information before it affects their payslip or their pension record are the ones watching channels like this one. Share this with someone who works abroad or with an employer who has not reviewed their payroll position since April. One conversation could genuinely make a difference to someone's retirement income. Subscribe to HMRC Update if you are not already here. I will see you in the next one.